Hi, welcome to London. We are in front of the Bank of England, and that's a good reason to reflect on what we've been seeing in terms of monetary policy development globally within the last couple of weeks. Often people talk about the herd behavior of investors. I think it's actually more reasonable right now to talk about the herd behavior of central banks. It seems like central bankers from the US to the ECB and to the Bank of England has decided that it's time to tighten monetary conditions. But why? If we look at inflation expectations, they've actually been declining in recent months. For most countries among the developed countries in the world, inflation is below inflation targets, and inflation is below, or rather inflation expectations are below targets. So why this certain urge to tighten monetary policy? Well, what it looks like is actually, and I think the Bank of England where we are right now, is that central bankers can't help themselves but looking at actual present inflation. So in fact, they're not necessarily only forward-looking, they tend to be backward-looking to a very large extent. In the case of the UK, inflation has been rising fairly steeply since last year's vote on Brexit. That caused the pound to weaken and has pushed up headline inflation. However, that's not really a monetary shock. That is mostly a negative supply shock that pushes up inflation, something which central banks shouldn't react to. That being said, it's probably been right for the Bank of England to ease monetary conditions, given the uncertainty and given the fact that before the referendum a year ago, UK monetary policy was too tight. However, over the past year, monetary policy actually became too easy. In March, we started to argue that it has become somewhat too easy and the Bank of England needed to tighten monetary conditions. However, if you look at our indicator for monetary conditions in the UK, it has actually been moving downwards, indicating tighter monetary conditions. Monetary conditions in the UK is maybe slightly too easy at the moment, and the Bank of England is likely also in a little bit longer run, 2-3 years, to continue to overshoot its inflation target. That being said, we are getting pretty close to neutral monetary conditions in the UK, and we have a very hard time seeing any need for any rate hikes now in the UK. Rather, what we see a need for is maybe to talk a little bit about it, maybe actually to act out a little bit, to push up rate expectations, maybe 5, 6, 8 basis points. And this is exactly what the recent debate has done in the UK, and maybe that in itself is enough to actually bring the medium-term outlook for inflation back to the 2% inflation target. However, where this is not needed is in the US, where monetary policy remains too tight, and where where the Federal Reserve is likely to continue to undershoot its target, and where the Yellen's Fed has been obsessively focusing on the labor market rather than on monetary conditions. We think there the policy mistake is more clear. So far, the ECB has done a quite good job in the last couple of years in getting monetary conditions right. But again here, Draghi's recent, slightly more hawkish comments makes us a little bit more nervous that headline inflation is driving monetary policy rather than expected inflation. So let's see where we are. But the fact that the Bank of England, the Fed and the ECB already in the last couple of weeks have moved in a further hawkish directions in terms of the communications is exactly what is reflected in the global stock markets, which have been starting to sell off in the last couple of days. And maybe a summer sell-off in the stock market is what is needed to wake up central bankers from the idea that they should look at present inflation rather than monetary conditions and the outlook for inflation. Let's see whether sanity prevails. Thank you here from London.